Hey folks, Dan Frio here, the Mortgage Update. Today is August 28th, 2020, and we're coming to a conclusion of the month, and the end of the month was a wild ride. So yesterday we had the Fed come out with some announcements that shocked the markets, and like I said yesterday, when it shocked the markets, mortgage rates jumped. So what happened today? Did they come back where I thought they would be in range? Or did they get worse? That's what we're going to cover next. So don't go away. We'll be right back. Okay, so here's what happened yesterday when the Fed kind of threw us a curveball. The Fed has basically two mandates that they go by, and they've gone by this for years and years and years and decades, is they try to control inflation and have it not exceed 2%. And they want the economy at full employment. Okay, so that's the two mandates that they usually run off of. What they came in with yesterday is saying we're going to more focus, I don't know if that's good English, but we're going to emphasize the full employment. So inflation, we're going to kind of throw back a little bit and say, the mandate is no longer going to be it's maxed out at 2, or they want to keep us at 2%. It's going to be an average of 2%. They really didn't come back and say how long an average they're going to look at. So basically, with inflation, say today at 1%, that means we can hit inflation in the next year or two up to 3%, and the Fed's still okay with it. So let me make it make sense. If they're saying we need an average of 2 now instead of a max at 2, so we're going to let it inflate higher than that, so we have an average of 2, not a cap at 2. So if we're at 1 now, to average 2, it would need to go to 3. So they're saying, okay, we're going to be okay with inflation even if it goes to 3% in the next few years, because the average will still be 2. Well, where that hurts the bond market and ultimately mortgage rates is inflation is the biggest enemy of bonds. The reason being is this, in its simplest form. If I invest in a bond and my rate of return is 2%, okay, so it's not much, but it's 2%. Inflation is 1. So inflation, let's deduct inflation off of that 2% return I have. It means I still have a nominal rate of return of 1%. Okay, I'm getting 2, inflation is deteriorating or taking away 1 of it, and it leaves me with a 1% return. So what is inflation? Basically, it's the increase in prices down the road. So my dollar today isn't worth $1 a year or two from now because of inflation. Okay, hopefully that makes sense to you. So what they're saying, though, is we're going to cap it if we were capping it at 2, let's say I bought a bond at 2, and now inflation's 2, basically my nominal rate of return is 0. Get it? Because I'm getting a 2% return, but prices are going up 2% a year, diminishing my purchasing power, brings me at 0. Well, let's say now they allow it to go to 3. I'm getting a return of 2. The inflation rate is 3, I'm actually a minus 1% a year, because if I hold that bond 10 years from now, I'm not going to have the same purchasing power 10 years from now as my dollar has it today. So that's why inflation is the biggest deterrent or the biggest enemy of bonds. And that's why yesterday we saw a major move in the bond markets, especially mortgage-backed securities. So let's get on to what happened today. My assumption was there was a lot of a knee-jerk reaction yesterday. And today we were going to recover a portion of that, if not all of it, because we haven't had inflation at 2% or greater in 2 decades. And we went through some major things back in 2007, 8, 9, and 10, and inflation still didn't pop after that, after all that government stimulus. But this government stimulus could change the world as we know it down the road. So that's where my biggest concern now is, are we going to overheat? We're not going to overheat for a while, and I got some of the numbers to back that up today. But what's down the road, you know what? Let's cross that bridge when we get there, because I think we're looking in, latter part of next year or 2 years or 3 years out. So I don't think we have a short-term worry. It's a worry, but let's let that kick down. Let's kick that can down the road to that point. So let's get on to it. What's happening today in the markets in regards to mortgage-backed securities? Well, we're all over the map, and you're going to see this is live pricing right now, and it is 1 o'clock Central Standard Time on Friday, August 28th. Watch this number, because I almost guarantee you this number is going to move as I'm talking, because it moved. We started the day with mortgage-backed securities up 11. You can see that here. We went up to 17 or 18. Now we're back down to 6. So this is all over the map. It's a Friday. Probably a lot of people having short days. Trading's taken effect. I think the knee-jerk reaction from yesterday is already in place. So that's what's going on right now. Here, let's go over some of the technicals in regards to this. And that's why we watch this chart right here. This is the mortgage-backed securities chart. This is what's happening to the price of mortgage-backed security bonds. All right. So this number here reflects what's going on with the price of a bond, the mortgage-backed security bond. When the price goes up, you pay more for a bond. It means you get a lower rate of return. So that's what we like. We want investors to pay up on this stuff, so it drives down the yields or the rate of return. We've had that. Okay. But starting about 2 weeks ago, we hit certain levels that kind of spooked me. And now we're seeing that those levels did stick in place like I thought. So let's go through these levels so I can explain to you what my thinking was and where my thinking is going forward. So look at this as a ceiling, a floor, and a floor. This is a short and a long-term ceiling right now. A floor, short-term floor, long-term floor. So these bond prices should fluctuate like this over the long term. In short term, they should kind of move like this, okay, which they're doing, and they've done for the past month or so. Well, we had a resistance level. It was right in here back at this time frame, and this time frame would have been back in July, mid-July. And we locked in a lot of people in this range because we kept hitting this ceiling, and we had resistance. So if this were a bond, if this is a stock, if this is whatever, technical people, traders, they follow these trends. Well, when we hit this area here and we drop back down, this signaled to me to lock in clients that were closing in the next week or two at that time, which we did. But then we had another little run in the market because of Corona 2 kind of reared its ugly head. And then we started hitting another pattern. You can see it right here. We hit a resistance. There was a resistance line right here not too long ago. And we kept hitting that one too. You can see we hit it, we hit it, we hit it, we hit it, and came back down through. When we exceeded it here, I hope you can see this. I'll try to zoom it in the best I can. And we started the next day here and started deteriorating. I locked everybody here. That was perfect timing. So if you're one of my clients, you applied 2 weeks ago or so, you're locked. You are good to go. From there, we saw a deterioration in the market. So here's what's happening throughout here is I said, if we start getting some good news in the markets, we could have a pullback, and where we should be is between these ranges in here when I was talking back in this time frame here. So bear with me here. Back in this time frame here, I said we can have a pullback that would get us between these two lines. This was a short-term ceiling and a short-term floor. So I said, okay, if we break it in half, there's where we probably should be in somewhat of a normal market. Well, we pulled back and exceeded that very quickly in a day. Then within 2 days, we recovered back to the line that I figured we would trade at. And we've been staying steady there for a while. So the next thing I said is, well, the next level that we will probably test, unless we break out of this and test these levels again, we're probably going to test an area right through here. The reason being is I'm splitting the difference between a 25-day moving average and a 50-day moving average. And that's why my trigger points have us here. Well, that started creating a floor for us here, here, here. And then yesterday we plummeted through it. So I didn't freak out and I didn't lock anybody here because I don't like to basically trade or lock in on panic. I said, this is a big move and we shouldn't be that low. We should get a reprieve, or we should get a little bit of a rally here to bring us back into these lines that I'm trading off of. And that's where we're going right now. We should be in this range, and we should be in this range for a while. The Fed came out. They basically told us everything they need to say. Economics numbers are coming out, and let's go through those. So today we had, this is the PCE. This is the inflation number the Fed watches meticulously. Let's see what that happened, where it happened there. Previously, we were at a 0.9. The consensus was having this particular inflation guide or numbers we thought was going to come in at 1.2%. It actually came in at 1. So it's hotter than it was last month or year over year, but it's still lower than we thought, and it's only halfway to the 2 number that we're looking at, the Fed, where the Fed's looking at. So then we look at core PPE, and that strips out food and energy. We expected a 0.5 increase, and we're at 0.3. That's good news. All this is good news for inflation. Consumer or personal consumption, people are consuming a little bit more. That's actually triple what the consensus was, but it was lower than the previous number. So I'm not worried about that. Personal spending is up quite a bit. Well, I think people are getting back to work. People are getting a little more comfortable that we're going to be at normalcy soon. So I think people are buying, or they put off a lot of buying of stuff and now they really need it, or they're back to work and so forth. So that's there. Chicago Purchasing Manager, that's right in line to where we expected it to be. And consumer confidence is a little bit better, as we can also see in personal spending. So none of this is really numbers that came outside the box that should spook the market. Next week, there isn't really much coming up as well that would cause my concern with anything. So let's go to some headlines, and you could see, let's just go through here real quick. Non-qualifying mortgages are coming back. No, they're not really. Mortgage rates tumble after delay to adverse things, and that was yesterday. Again, you have to take this news with a grain of salt. Most of the mainstream media, they are giving you data or mortgage rates. They compare it Mondays and Tuesdays of one week to the Monday and Tuesday of the following week. Well, Monday and Tuesday of this week was good. And then all of a sudden, Wednesday, Thursday, we kind of had a bloodbath with mortgage rates. They increased, especially right here, Thursday. We had a complete bloodbath yesterday. So how they're saying we have better rates today because of the ease in what the Fed came out with and other stuff is absolutely incorrect, inaccurate. So that's the news there. And that is it for today. So it is Friday. It's the end of the month for us. We basically closed up everything we needed for the month. We got some straggling purchases to clear up for the month. And that is where we are right now. If you'd like to reach out to me personally, I apologize about this one. It might have been a little bit of a boring session because there's really not too much going on except a little bit of a recovery. Let's go back to this. You see it. I told you it's going to be moving, and it's kind of all over the board right now. I am not locking anybody in. So if you liked what I do here, what I would greatly appreciate you to do is please reach out and follow me. Give me a thumbs up. Subscribe down below. I'd love to hear from you. Leave me some comments on some areas you want me to look over, explain to you how escrows work. How do you buy a house? How do you refinance? Does it make sense to refinance? How do you compare rates? How do you compare lenders? All this stuff is what I explain to you. And every Tuesday I go in and I compare my rates against rates throughout the whole country in different parameters. Next week, I just found a sweet spot that we have We have a jumbo program that is blowing the socks off of everybody, and I'm going to go over that on Monday. So a little teaser for you guys out there. If you need a jumbo mortgage, you might want to hold out till Monday, because I can almost guarantee I can beat any rate you got out there. So if you'd like to reach out to me for my help, all you have to do is go to therateupdate.com, scroll down, and this gives you the personal how to get a hold of me personally. It's 844-775-LOAN. That's 844-775-5626. Here's all my social media. Click there and join, subscribe, follow, trend, befriend, however you want to do there. If you'd like to reach out to me personally, and I'm going to tell you why you might want to look at doing that, is if you're in the mortgage process right now and want a second opinion, send me what's called your loan estimate. Every time you start a mortgage, the lender has to give you what's called a loan estimate or a fee worksheet. And basically what that does is it gives me your home value, or at least your address. It gives me the loan amount that you were approved for, gives me the rate and the fees, okay? The biggest piece of this puzzle is I need the home value, the loan you're looking for amount, and your credit scores. If you know your credit score, at least say, hey, my credit score is X. I think it's 750, it's 760, it's 780, it's 580, it's whatever. If you get it from Discover Card or whatever, give me that number. Is it 100% accurate? Probably not, but it's going to give us in the range. If you don't have a credit score, I have a sponsor of the show. It's called Credit Scores and More. It's plural. So creditscoresandmore.com. Just go there. Step one is a free credit score. There's no gimmicks. Trust me, there's no gimmicks. Doesn't even ask you for a credit card. And if it wants you to upgrade the services or whatever, don't do it. Just get the free credit score. If you want to know your real credit scores that lenders use, you can click step 2. It's, I think, $40, especially if you go through that site. There's a discount, and it gives you all 30 plus credit scores that you have. Kind of confusing. If you get it, if you'd like me to walk you through it once you do order that and get it, I know it like the back of my hand. I can walk through it and explain the whole thing to you. And then if you're really struggling with collections, judgments, getting your scores up or whatever, step 3 is a credit counseling system that's fantastic. So that's it. So I hope that you have a great weekend. Oh, how do you send me this information if you want to reach me personally? You can reach me. My name is Dan Frio. Reach me at D for Dan Frio, which is Frio, at preferredrate.com. That's my email address. So God bless. Have a great weekend. Don't forget to give me a thumbs up. Subscribe down below. Trying to hit 10,000 subscribers by the end of the month, and we're 400 short. So I need your help. So other than that, have a great weekend. Relax. Be safe. And I'll see you next week. Bye-bye.